Hey there, thanks for joining us for another live Philip Nova webinar. We'll be kicking off very shortly at about 7 p.m. So if you're having your dinner, sit tight, enjoy dinner. Hope you enjoy the content for today. We'll be discussing about gold and silver, and we'll have David Ng to walk us through his thoughts and insights on gold and silver. So stay tuned, we'll be kicking off very shortly at 7 p.m. Talk to you in a bit. All right, my time is now 7 p.m. Let's get started. All right, ladies and gentlemen, thank you for joining us for another Philip Nova live webinar. And today we'll be discussing gold and silver in a shifting world, safe haven or speculation. What do you think, guys? All right, so gold and silver, as we know, are breaking records in 2025, and gold has soared more than 40 to 50% year to date. But silver is outpacing it with gains up to 60% amid booming industrial demand, right? So what's driving this surge? It's a mix of several factors. Inflation concerns, you have interest rate expectations, currency weakness, and even ongoing geopolitical risks around the world. So in tonight's webinar, we'll be deep diving into these key points, like which are very important for us traders. Firstly, what kind of fundamental forces are pushing prices higher, right? Whether this rally can be sustained or is it overheating. Gold has pulled back slightly. It's at about the 4187 mark. Will we see it push higher up in the coming months and bring new highs, like how it's been doing at the start of the year? And how we can navigate the price swings using technical setups and identify entry entry points for gold and silver, and what are the various ways you can participate in the gold and silver market, futures contracts in the precious metal space, including how we can use them for exposure. Okay, so if you're looking to hedge, trade, tactical moves, or invest in precious metals, this session will give you an overview of the practical tools as well as actionable insights to make informed decisions. All right. Let me tell you about Speaker. If you've been joining us for our live webinars, he should be no surprise to you. He's none other than David Ng. He's a proprietary trader with Iceberg X Narbahat, a local prop firm based in Kuala Lumpur. He's done extensive research and is well versed in the commodities and indices markets. He currently trades the Malaysia Index and the crude palm oil futures. Okay, so before I hand the time over to him, can I just do a quick sound check with the wonderful members of the audience that we have here? Okay, at the same time, I want you to go to, okay, let me know if you can hear me loud and clear by going to your question box and typing a yes in there. Okay, the question box should be somewhere at the top if you're using a desktop, or it should be somewhere at the bottom if you're on mobile. Just type a yes in there if you can hear me loud and clear. Okay, look for your question box and type a yes in there. Just let me know you can hear me. Oh, brilliant. Thank you so much, Motley Crew. Cool name. All right. Thank you so much, James, for letting me know as well. Okay, you can hear me loud and clear, and I'm going to hand the time over to David right now. At any point in time, or if you're afraid you're going to forget your question, you can type your question in here, and then we'll pick it up during the Q&A session towards the end of the webinar, especially if you have questions on gold and the silver market. I think put them down here so we can address them towards the end of the webinar. Thank you so much for the resounding yes I'm receiving in the question box. All right, David, looks like the audience is ready. Are you ready to go?
Yeah, hi Sri. Yep, I'm ready to go. Just a quick sound check. Are you able to hear me?
Yeah, loud and clear, David.
Yeah, okay, that's great. Yep, let's kickstart. Thank you Sri for the very kind introduction. And obviously, just thank you Philip, Noah, and also CME for inviting me to speak on today's topic. Mainly talking on gold and silver, the precious metal space. And as what Sri has highlighted earlier, now it's the season, or now it's a scenario where you've seen precious metals actually rallied quite aggressively, especially in this year. Both of these precious metals actually up by almost 50% year to date. This is a massive performance. In fact, I think it's outstripped many other major asset classes as well. Now, gold and silver are part of precious metal, and it's also part of commodities. Now, commodities in general has not been doing well, with the exception of gold and silver. If you just look at other commodities, whether you're talking about oil, whether you're talking about grains, majority of commodity asset classes actually been doing badly, with the exception of the precious metal space. And in the next half an hour to 45 minutes or so, we're probably going to dive into what are the factors that actually drive those prices, and can the rally that we see in the current juncture, is it able to sustain itself for the next leg up, or is it going to face a potential retracement that is bound to happen in the market? So let's just go through with the slides. So first thing first, I just want to get it out is to put a disclaimer out. So any materials presented here today is purely for educational purpose. So if you are new to futures market, futures is a derivative instrument. So make sure you're well equipped and well get the sufficient knowledge, before you actually kickstart your journey in futures trading. So in this regard, probably you can talk to Philip, Noah. I think they are more than happy to aid you and to assist you in your futures trading. Besides that, I think any opinion that's presented is purely reflecting my own personal opinion. It doesn't reflect any opinion, whether it's from Philip Noah or whether it's from the exchange itself. It's take it more of an educational purpose. And keep in mind, markets are now very volatile, even in the precious metal space. So, with every trades that you do, always make sure that you have a plan in place, and make sure it's comprehensive enough. Now, I think some part of the agenda that we're going to cover in the next half an hour, 45 minutes or so, is just looking to some of the factors that actually affect gold prices that we're seeing, especially the rally that we're seeing right now. And this is mainly down to the demand factor that's actually been quite aggressive. Now, there's a couple of major demand factors for gold. One being is that that is general investment demand. Whether it could be in terms of ETF flows that's going into the gold space, and it could be also central bank buying. Some central bank buying has been a major theme for the past several months. In fact, it started back in 2 years back, when China actually slowly creeping up into the international market to purchase gold in huge quantity as part of their central bank purchases. So that actually drive the momentum And obviously there's also other factors that's also keeping the gold prices sustained at elevated levels. Mainly is down to geopolitics and also certain key countries in terms of their key monetary policies. Now, other than that, you can really see that really the market is self-sustaining, but eventually, with any upside potential, there's bound to be potential retracement in such an upward move, and that's where technical will come into the picture. And it's important that we should be able to navigate markets with the right technical tools and setups accordingly, which I'm going to share in the second part of this webinar, whereby we can use certain trend tools or trend indicators to help us to navigate the market, especially during a high volatility period. Last but not least, I'm just going to share with you, if you are new to the gold futures market space, CME contracts, CME Exchange has actually launched a couple of new contracts, and nowadays I think with small contracts with margins that is much lesser required, it allows traders to actually participate in gold market. Given the fact that markets are more volatile, there's obviously more opportunity in the market. So with smaller contracts, with smaller margins requirement, it actually enables traders to participate or gain an exposure in the gold market. Now, just to give you a brief overview where gold prices actually been hitting at this point in time, so you can see that back in after the financial crisis in 2008, global financial crisis, we can see that gold has actually been hovering around 1,000 or 1,500 mark for pretty long time, and it's been hovering between the 2,000 ounce level for almost a decade. And since after the pandemic, that's where you can see gold started to rally quite aggressively, and especially in the last year and this year as well, gold actually in fact make a mark, hitting all-time high levels, reaching almost 4,400 US dollar per ounce. So really, what's driving is there's a lot of fundamental factors, but the key thing is that when things are getting uncertain, when there's more uncertainty in the market, whether it's economic uncertainty, whether it's policy uncertainty by governments, it really pushed the appeal for gold. And going forward, I think gold will sustain itself as pretty much like what the headline says, is a safe haven asset, and you need it as part of a tools for diversification or asset to diversify against market risk. Now, if you just look at gold prices, it's actually rallied from low levels from 3,000 US dollar to right to 4,000 US dollar in a short span of about a year. And you can see that daily volatility in terms of gold prices actually increases. So on normal days, probably you're looking at about $50 range from high to low in gold prices. But nowadays, just a couple of months back, given the volatility nature with policy uncertainty, with economic uncertainty, you can really see that the daily volatility range for gold is actually increases from easily from 50 to average about 100 to 150 US dollar per day. So if you are trading the market, really you got to be very careful, because when markets are more volatile, obviously there's opportunity, but there's also higher risk involved. So always make sure that in any setups that you do, you must have a way to get yourself out in case the market go against you. That's where stop loss managements are very critical during time like this. So just to compare different asset classes and how they've been performing throughout the year, you can see that gold and silver are sitting right at the top. They are easily consecutively they are up. Gold is up by almost 50% year to date, and silver is outperforming gold in certain ways, and it's up almost 65% year to date. So that's it's a remarkable performance, and really I think this is the year for precious metal. Now, whether the rally can continue itself is still pretty much to be seen, but it's pretty much on a strong footing, and as long as the fundamental factors are keeping the appeal for gold, appealing, and I think the price will sustain itself at these elevated levels. But if you compare to other asset classes, precious metal is definitely sitting on the top in terms of their performance for the year 2025. Now, in terms of market cap, gold is definitely catching up. If you just look at S&P 500 as equity market cap, is sitting on $60 trillion. It's huge. And gold is not too far away. Gold is, I think those days we're looking at gold at about 10 trillion. Now it's at 26 trillion. So the market cap for gold is slowly inching higher. That shows again that the appeal for gold as an asset class, whether it's for diversification, whether it's part of your portfolio, is pretty much getting more demand. And it will continue to do so as gold continue to be proven as a safe haven asset, and is continue to reduce the overall volatility of your portfolio. Is therefore appealing to have gold as part of your asset class. So that create demand in general, and that will definitely push prices higher. And in other words, the market cap for gold is also going to increase eventually. Now, sitting there also, you can look at Bitcoin. Bitcoin is also trying to inch higher, despite there's a bit of retracement in the Bitcoin market in terms of Bitcoin prices of late. But it's still pretty hefty in terms of their valuations. Silver is the one that's also catching up quite rapidly in terms of their market capitalization. So really, I think gold and silver is starting to gain appeal of being an asset to hold, whether it's for diversification, whether it's for diversity, but it's really an asset class that's needed to be part of your portfolio. Now, I think one of the major driver that drive the rally in gold prices is really the demand investment that's coming in, or demand inflow that's coming into the ETF gold segment. So, as people are starting to see that when gold are inching all-time high levels, that create an appeal, and people are starting to pay notice to that, and so therefore that also in a way generate interest in the gold market. So in the last couple of months, we've seen quite major inflows. That explains why gold prices actually rallied from 3,500 to easily to cross the 4,000 ounce level mark in quite a short span of time. So as long as these investment demands are being sustained, we can clearly see that gold prices can still continue to rally. But be cautious that once every time when there's a high prices or gold create high all-time high prices, there's always an interest, especially for those who have positions in the gold market, to liquidate some of their positions as a profit. So eventually, high prices will generate a lot of selling interest, and in a way will taper down that upward momentum. So be careful. Once ETF starts to become the inflow starts to taper down or starts to dwindle, that's where you can see price momentum for gold will also start to have an impact. So be cautious. Once ETF inflows are starting to peak, that's very likely we can see pressure in gold prices as well. Now, I think really, China has been the major team when it comes to gold market in terms of buying aggressively. So not only central bank is buying, if you just look at the investment demand from China, especially when it comes to gold ETF inflows are also quite significant. So they are doing either ways. I mean, they are buying the bulk in physical gold, mainly by the central bank. They are also investing into paper contracts in the gold market as well. Also, that explains why there's a lot of interest coming from China into the gold market space. Now, China being China, they are also very price sensitive. As long as gold hitting all-time high prices, normally that will also be a lot of interest from all these investors. Be a position for them to start to liquidate their positions, and that's where high prices will always attract selling interest as well. So we really have to be mindful. Once the momentums or once the selling interest starts coming in, or the buying interest starts to taper down, that could mean there's definitely pressure on gold prices at that point in time. Now, so if you just look at four major factors that drive the overall demand for gold, if you break it down to mainly jewelry demand, technology, investment, and obviously central bank, you can see that really the central bank and investment is the key factors that drive gold prices. Now, jewelry, there's pretty much a bit of in terms of the demand is actually quite sluggish, because retailers or generally people who buy jewelry, especially when you have high gold price or all-time high gold prices, they'll probably be waiting anxiously for the price to come down before they make their purchase. So jewelry demand actually got affected when gold prices is actually at all-time high. Now, other than that, I think really the central bank, the investment demand, these are the two major drivers that actually push up gold prices to elevated or all-time high levels. So keep in mind, jewelry, although is not much of an increase. In fact, we saw a decrease in terms of overall jewelry demand, but it's still a major factor when it comes to overall demand for gold. So as long as gold price remains high, it's definitely going to impact a lot of consumers, or rather the consumers will be holding off buying gold at that point in time, because gold prices are still at all-time high. But once gold prices start to retrace, you can see that jewelry demand will start coming back, and that will also help to support gold prices in the short term. Now, central bank is the one that is really is a major buyer, especially coming from the Asia side. China being one of the largest buyer for past couple of months, especially from whether it's in terms of trying to moving away their interest or moving away their dependence on the US dollar as part of their reserve interest. and diversify into gold. That could be a major reason, or it's mainly geopolitics in that regard. But having said that, I think that clearly shows that they are really interested. China central bank is really interested to diversify some of their holdings away, or putting less dependence from U.S. Reserve assets, and putting that into, or transfer that into the gold market. So you can see that there's a lot of buying coming from China central bank. But the key thing is that, although this data does come out a bit late, as long as it shows there's still momentum coming from China to buy, I think generally the market is still quite okay. But as I said, China is also very price sensitive. As long as, if gold price remains elevated and remains at quite a high level, eventually you can see that purchases also starts to taper down, and that's where we tend to be a bit more careful and more cautious whenever central banks buying starts to slow down. That usually means that you need an additional demand to support the market. If not, generally the price would tend to react. So that's where we tend to be a bit more careful nowadays, whether China's central bank can still continue its buying momentum. But if you just look at the past couple of months, it still quite show quite minimal incremental growth month to month. But again, gold price at all-time high levels. Eventually, that will also spell that the buy momentum will tend to peak at certain point in time. So we just have, if you're looking at the market, be more cautious on China central bank buying. Eventually, they have to slow down, given the where gold prices is at this moment. Now we are almost the last month in out. I mean the last month, one more month towards the end of 2025. You can see that the buying momentum overall this year, in the first 6 months started well, but when gold prices hit, and when it breaks the 4,000 mark, we can really see the buying momentum starts to dwindle down a bit. So eventually, I think 2025 will be a year that you probably see a lesser in terms of buying quantity as compared to 2024. That's because gold prices are actually hitting at all-time high levels. The key question is that in 2026, if gold prices remain as it is, can central banks be a major support in terms of buying from the market? That's a very that's going to be a very important variable to look at. But in my opinion, I think that uh, China central bank will probably slow down their purchase right until when price starts to retrace to a certain level. That's where their interest will start coming back again. But I think as of now, you can see that China central bank has, in the past couple of months, especially last 2 months, they slowly starts to slow down in terms of buying gold, given that where gold prices is hitting at all-time high levels. So key crucial to watch, the 4,000 is a psychological support mark. So if gold prices were to break below that, generally that means there's going to be a healthy buying coming back again. But anything above that is considered quite elevated when it comes to price sentiment. Now, it's not only China that is aggressively buying into gold. You can see that pretty much around other regions, like whether it's in Europe, whether it's in US side as well. You can see that generally when gold prices break above the 4,000 mark, it creates interest again. So central banks around the world are starting to realize that gold could be a safe haven asset once again, given that the different uncertainty when it comes to monetary policy, and different countries implementing different measures. So gold as a asset class to create that certainty, it creates the appeal again. So you can see that general interest of central bank going into gold as a reserve asset is slowly inching higher. So if you just look at over the past decade, those days a lot of central banks will probably hold currencies as their main reserve asset. Nowadays you can start to see that they're converting some of their currency reserve asset into gold. And right now you can see that the percentage is slowly climbing and is quite sustainable. So these are all creating robust demand for the gold market in general when it comes to the overall demand for gold. So as long as central banks generate interest to buy gold, I think that's going to create a support, or a strong support for the gold market. Now let's talk about other factors. Now you just look at it, gold is moving quite inversely to the strength of the dollar. So when US dollar starts to weaken, you can see gold actually gains strength. So it's an inverse relationship between the dollar index and also gold prices. So right now you can see that U.S. interest rate is in U.S. federal interest rate is on the downward path, and that's going to create a weakness in the U.S. dollar, and therefore that will also be appealing for the gold market. So if you just look at it, I think you can see that weakness in the dollar is going to be is going to create a support for the gold market in a short-term basis. Now, besides US dollar, another key point is that gold in general is a non-interest bearing asset. It doesn't, if you hold gold, it doesn't pay you interest, it doesn't pay you dividend. It's purely based on price appreciation. So whenever you have a high interest rate environment, especially in the past couple of years where US interest rate is hovering around the 4% to 5% mark, it creates a lot of disincentive to hold gold because you can just put your cash or you can put your assets into interest yielding assets like US Treasury that pays you 5%. Instead of you put gold, it doesn't give you any interest. It all depending on the price appreciation. So when interest rates are expected to come down, that's where there's incentive to hold gold because the marginal cost of holding gold will start to come down. Interest rates starts to come down, the cost of holding gold starts to come down. So it creates an appeal again when U.S. is Federal Reserve is moving into a lower interest rate path. Again, it's going to be something that's going to support the gold market when it comes to demand for gold because the marginal cost of holding gold is going to be lower given the lower interest rate path in the U.S. Now, when talk about interest rate, obviously we are one final meeting for the year. We are just a couple of 2 weeks more into the FOMC meeting, and you can see that the interest rate decision in US is still quite mixed. Now, the funny thing is that I think last 2 weeks ago the sentiment was that there probably will not be a interest rate cut in December. But once when economic data starts to come out and start to release, you can see how weak the economy is, and therefore that create an incentive for the U.S. Federal Reserve to continue to cut interest rate in the next upcoming FOMC meeting. So that also will create, as I said, lower interest rate will definitely be something that will support the gold market. Now, if you are trading the gold market, FOMC days are usually very volatile. So if you don't like, big spike in prices, or high volatility, price movement, try to avoid those FOMC days. But I think the next FOMC decision will likely be something that will create a lot of volatility in the gold market as well as other asset classes as well. Now, if you just look at gold and S&P 500 movement, you can see that over time, gold should be acting as a safe haven asset, whereby if the equity market starts to fall, you can really see that gold will come in as a way to diversify market risk by performing well. So when you start to see S&P 500 starts to come down, normally you expect gold prices to go up, but that relationship has actually in a way broken up. Nowadays, you can see that when S&P 500 starts to come down, you can see the same parallel movement in the gold market as well. So it's more of an interest or more of a fund flow that is coming out from market. So when there's jittery in the market, regardless of any condition, equity markets are pretty much peak as well. And also gold market in a way is also stretched in terms of their price movement. So fund will tend to move out of those markets when there's jittery in the market, whether it's uncertainty or whether it's geopolitics involved. So you can see that nowadays there's more of a parallel movement between both markets, the S&P 500 and also the gold market. Now, is this a good barometer to watch the gold market in relation to S&P 500? I think I would say it's very difficult. Those days is much easier. The relationship is much more clear in the sense that when S&P 500 is down, normally I expect gold prices to go up. Nowadays you can't do that. These both markets are actually quite interlinked and quite intertwined with the overall market conditions. So like I said, funds are into both markets, and when there's uncertainty in the market, funds will just pull out from both markets, and that explains why they are moving quite parallel in fashion. So I mean, watch closely. Certain relationships that used to work previously doesn't work in this climate and this current economic climate and condition, given the fact that nowadays funds are moving different or having different perspective of how the overall market works, and pretty much markets move on fund flow. So that's very critical to watch. Now, if you just look at this, is just looking at VIX index. I think past couple of weeks during the Trump tariffs and geopolitics being involved, you can see VIX starts to climb. And generally when VIX is usually termed as a fear or fear gauge or fear index. When there's fear in the market, normally people rush into safe haven asset, and gold is being one of it. Now, VIX, although is climbing from a low level between 9 to 20 points, anything that's above 20 points considered as rising risk in the market. But I think right now probably has actually tapered down from 20 levels to right down to about 15 or 14 levels. So it's again telling you that it's not a condition that the market, although it suffers short-term jittery or short-term uncertainty in the market, but it's not so fearful that it warrant that holders or fund managers will move into the safe haven space. But it's worth to pay attention. So any condition that you see that big spikes to certain levels, normally that also will be a rush, or that will create or prompt fund managers to move into safe haven asset as well. So in a way, gold prices will also benefit in those type of movements. So weeks is one barometer to watch, whether there's fear or there's uncertainty in the market that warrant fund managers or fund flows to move into the safe haven space. Now, if you just look at comparing open interest positions and against where gold prices is, you can see that in the past couple of months when gold broke the 4,000 psychological resistance, you can really see that a lot of people participate in those markets. How do we know that? You just look at interest positions. Open interest positions in the market actually was rising at those point in time. So when you have a rally, a general price rally in the market, accompanied by rising open interest position, that normally means that the trend or the rally is actually quite healthy or quite sustainable. Because there's no point if this price rally or price rallies up, but the open interest doesn't follow along, or rather people are just quite skeptical whether this rally can sustain itself. So they will not participate in the market. So when you have a price that's rallying up, but the open interest positions are coming down, or in fact is flat, it's not a good thing, because normally that means that the price rally cannot sustain itself. But in this regard, you can see that the gold price actually rallied above the 4,000 mark, and that accompanied by rising open interest position. So that tells you that generally the traders are also participating in the uptrend movement. So as long as open interests are remaining or remain rising during a price rally, that shows that the price can sustain itself. So even though I think in recent weeks we saw that the open positions are still rising, so that's giving a bit of in a way of market sentiment play that this price rally in gold market can sustain itself as long as people participate in the market. But be very careful whenever there's a price rally but open interest doesn't follow along or doesn't rise along. That usually means that pretty much the price has peaked, or rather a lot of interest from the market is that traders sees that the rally in price will be a good position for them to exit their current positions. That's why open interest either stays flat or starts coming down, and that usually not a good sign when it comes to a price rally. Now, besides rising open positions, you can see that the generally net positions in the market, especially in COMEX, you can see that generally investors are holding into net long positions, and in fact, these net long positions are also rising. So generally, that tells you investors are still expecting that this price can sustain itself and can continue on the leg upwards. So be careful. As long as net long positions starts to become flat or starts to come down, despite the price is still rallying, that usually be a sign that price probably has reached a temporary peak itself. Momentum and sentiment markets can also reach its peak. So be mindful and be watchful when it comes to the net long positions in the market. When those net long positions starts to taper off or becoming or starts to dwindle, that generally tells you traders are actually taking out their long positions and probably closing their net long positions, and that could spells a temporary peak in the gold rally. Now, other than that, if you just look at production cost for gold, it's rising over the years, given the fact that inflation is always a persistent concern, and that means it's always spell a general price increase over across the board. So cost in general has actually been climbing over the years. But if you just look at where the all-in sustaining cost for gold right now is hovering around $1,500 per ounce, and given where gold prices is at this point in time, it's quite a good margin for a lot of gold miners. You're talking about easily close to 2,500, or $2,000 per ounce in terms of margins. So that's actually a quite good amount. in terms of profit margin for a lot of the gold miners. But keep in mind, as rising costs are climbing and inflations are being a factor into the cost of production, we're going to expect cost of producing gold is going to inch higher and higher year on year basis. So in a way, that's also providing a floor as to where ultimately if gold price were to come down to a certain level, it usually be where the cost level is at most times. Now, look, talking about silver, I think silver have a tremendous rally. In fact, it's actually outperforming gold in the last couple of months. But if you just look at this chart is showing you the gold silver ratio for the past decade. You can see that the long-term average in terms of gold silver ratio is hovering around the 75 to 80 mark. It went as high as I think about 110 early part of this year, back in March or April, when gold prices starts to climb up above the 3,500 US dollar mark. But silver was actually not moving as much. I think then eventually silver broke a few key resistance, and it becomes appealing again. So silver, if you just look at where the current ratio is clearly outperforming gold. The ratio right now stands between 71 to 72 mark, which is consume meaning that gold is generally relatively undervalued as compared to silver. Now, silver there's not only silver is not only used purely as a precious metal or whether in that league for a safe haven asset, but it's also used for mainly also for industrial demand. So there's additional demand that can come into the picture for silver market. So personally, I think is that silver have a bit more upside, and therefore I think once the ratio it can go even lower below the 70 mark, which is below the long-term average. So that tells you the potential for the silver market is definitely there as compared to the gold market. So that's pretty much covered on what are the fundamental factors that actually cause the rally in gold and silver prices. Now, I think the key thing to watch is that as long as central bank being a major buyer and the appeal for gold, given that the interest rate is starting to come down and the weakness of the dollar, these are the few key factors that's actually going to support the gold market in a short-term basis. But keep in mind, price is elevated. We are at all-time high prices. That always will create selling interest among the market participants, and that will put a temporary pressure on the gold market. But having said that, I think the long-term prospect for gold is remain very relevant. It's still there as uncertainty prevails, whether it's geopolitics, whether it's economic uncertainty going into 2026. Things are not looking so well in terms of economic. So therefore, I think the appeal for gold will always remain. So I think it's high time, if you're not using gold as part of your asset class, you should look at it. And if you are trading gold, I think given that the volatility nature of gold is getting more volatile these days, as I highlighted earlier in a couple of slides, the daily range for gold is no longer $50 mark. You are talking easily about $100 movement per day. So that's usually create a lot of opportunity, but that also comes with risk. So always make sure that you must have a way to manage risk. So now comes to the part where how can we create a particular setup of trading plan that we can use to navigate the market. Now, I think in common fashion, when you trade the market, there's always two ways or two major ways to trade the market. One is whether you are looking at trends. So if the market is trending, you trade with the trend, not against the trend, but with the trend. So if gold market generally has been a bullish market, so always find opportunity to long rather than short. So trade with the trend. Now, another way is to look at when markets are ranging, we use range trading strategy, or what we call mean reversion. So that usually means that if the market is trading at a very tight range, so use mean reversion like stochastic or your RSI or or any other mean reversion indicators to help you to trade using a range market. So in today's setup, or pretty much in what I'm going to share is probably mainly talking about trends. So if the market is trending, we use trend tools that help us to navigate the market, especially when it's trending. So there's many ways to identify whether the market trends. One is to look at moving averages, or you can just look at the chart visually. The way to look at it visually is as long as the candles are getting higher, the highs are getting higher, the lows are also getting higher. Generally, it's an uptrend market. We've seen that in gold. The highs are getting higher each day. That's why we create all-time high prices. Now, vice versa, if the high is getting lower, the lows are getting lower, generally that means it's a downtrend market. Now you can use moving average to also try to identify trends. How we do that is that we just plot our moving averages and we look at where the candles are. If the candles are above the moving averages, generally that means the market is uptrend. If the candles are below the moving averages, generally that tells you the market is on a downtrend basis. Now I just want to introduce to you the Heiken Ashi candles. I'm not sure how many of you are familiar with Heiken Ashi candles. Now Heiken Ashi candles are getting very popular when it comes to trend because it helps to identify trend in a much clearer fashion as compared to your normal Japanese candlesticks, which is widely available. So why Heiken candles are so popular? Because it helps to to identify trend or distinguish trend in a very distinct manner, which I'm going to share with you later on a couple of slides. So Heiken is a great tool to use to identify trends in the market. Then obviously you can couple that with moving averages or another great trend tools is what we call DMI trend indicator. Now DMI is also part of our moving average crossover, which I'm going to share with you later on how we're going to use that. But I think importantly is that this DMI tool it has another line which is called ADX, stands for average directional line. And this ADX is important because once we identify the trend, we need to know whether the trend is it strong or weak. There's no point for you to enter a particular trend when the strength of the particular trend is weak, or eventually it's going to peak out. So you want to enter into a particular trend when the strength of the trend is still strong. So how do we do that? We look at the ADX value. And the last bit is that with every plan or every setup that you have, you must have a way to get yourself out in case the market go against you. And the way we do that to manage our stop loss is to use ATR value or multiples of ATR. So I'm just going to share all this, how we go and do that step by step. So first thing is that to identify trends in the market, so we can look at it visually as I mentioned. So compare the highs and the lows. If the highs are getting higher, the lows are getting higher, generally that's an uptrend market. If the highs are getting lower, the lows are getting lower, it's a downtrend market. So that's visual identification. So you can see here, on this part, if you look at back in May towards to August period, January is quite a tight market. The gold was trading between 3,200 and 3,500. It really broke up, especially when China starts announcing that they are buying a lot of gold in the open market, and that suddenly there's a surge in demand. So once you broke the 3,500 mark, you can see that on daily basis the daily candles are getting higher, the highs are getting higher, the lows are getting higher. January is an uptrend market. But having said that, you look at overall, if you plot a moving average, so this is a 50 period EMA and against a 200 period EMA. So you have a shorter EMA time period and a longer term period EMA, which is the 200 period EMA. So I mentioned earlier, as long as the candles are above both the moving averages, is generally telling you the market is still an uptrend market. And generally, if the candles are trading above, generally tells you there's upward momentum. But what I want to highlight here is that if you notice, there's a couple of occasions where the candles are just sitting above this red line here, which is the 50 period EMA. So it is crucial because moving averages are not only telling you where the candles positions are to identify where the trend of the market is, but it's also acting like a dynamic support for your candles. So as long as the candle doesn't break below the moving averages, it's just telling you that it is well supported. This uptrend that we're seeing since the beginning of 2025 is still quite intact. But the moment it breaks the 50 period EMA, that's where you got to be more careful. And therefore, the next test will be the 200 period EMA. So you can generally say that despite this time period between May and August, the market is ranging between 3,000 to 3,005. It is still holding on an uptrend basis and is well supported by the 50 period EMA. So keep in mind, I think moving averages are also acting a very strong dynamic support and resistance level for a particular candles as well. Now, silver, like I said, beginning of the year, there's not much of movement. It's holding at a very tight range, but it starts to wake up, especially when you start to notice the gold and silver ratio went to as high as 110. That means that gold is way overvalued and silver was the underdog. And clearly, I think once people realize that silver has much more potential, you can see there's a steep price rally in the silver market. Now, generally, you can see that most of the candles are still holding above both the moving averages. Definitely the highs are getting higher. It's generally still an uptrend market for the silver market. And clearly, as long as the market is an uptrend market and you're doing a trend position, always find always enter position with the trend. So if it's an uptrend market, find position to long rather than short. I know there's always a tendency for us that in an uptrend market, if it's reaching almost at that peak point of the chart or the candle, if you want to long, there's always a pain point in us, because you'll be thinking that, oh, is the market going to continue to rally, or if the moment I enter at a peak, it's going to come down. There's always that kind of fear that creates in us, especially when you try to enter during the peak of the candle during an uptrend position. But like I said, the market can trend for quite a while, and in the trend, it's always best to trade with the trend and not against, because once you try to uh, be in a position against the market, especially during a strong trend market, is always very painful. So that's where you need to be careful whenever you do trend trading. Now, so I comparing these two charts here. These are basically looking at the gold chart, and basically the same time period. The only difference is the type of candles used. So on the left, we have the normal candlesticks, and on the right, we have what we call a Heiken Ashi. So if you notice, is that uh, one thing that's very clear is that in candlesticks you see a lot of series of a few series of green, and later you start to see a series of red bars. So if you're trading on a daily basis, you'll be thinking that, oh, look, this is when the moment you start to see periods of consecutive of green days, and suddenly you see a red appearance of candle days. That's usually be a period where, oh, you start to think that this uptrend is not going to continue. It's probably going to go on a downtrend. Now, if Heiken actually is try to filter that noise by taking the middle bar of normal candlesticks, and if you look at it, it represents the gap, the price gap by the candle bar itself. So in a way that you can clearly see whether the market is still heading on an uptrend, or is it going to face exhaustion and is going to start to be on a downtrend. So in a sense, that Heiken actually is painting to you a much clearer picture of how the market trends, rather than looking at Japanese candlesticks where you're not sure whether is the market still in a trend phase, or is it going to be in a consolidation phase, or heading to a retracement phase. So Heiken actually helps you in that regard. So I'm not going to go too much on introducing Heiken. Actually, nowadays you can definitely get all this information on the internet. Now, Heiken actually is so popular not only because it's useful for trend identification, but again, Heiken actually is based on a fixed formula. So if you are doing coding, or if you are doing algorithmic trading, you can definitely program Heiken actually candles in your particular software, because it's based on a fixed formula. Now, the difference between Japanese candlesticks and Heiken Ashi is mainly down to three major distinct points. So Heiken Ashi is mainly used for trend. Japanese candlesticks is mainly for reversal. And Japanese candlesticks, if you look at some of the key books like Steve Nissen's books talking about candlesticks, he talks about 100 over patterns. To really master candlesticks, it takes time and effort. Now, Heiken Ashi, there's only three distinct patterns that you need to know, and with these three distinct patterns, it helps you to identify trends in the market. Now, I wouldn't say it's a drawback, but the only difference between Japanese candlesticks and Heiken Ashi is the price gap. So if you are looking at gap strategy, no, you can't really use Heiken Ashi. You have to convert your Heiken Ashi candles back into Japanese candlesticks if you're looking at price gaps or gap trading strategy in that sense. So what are the three distinct patterns? So Heiken Ashi, the first distinct pattern is that as long as you see the green color bars means the market is going up, red color bars, market is coming down. Now, if you start to see green colored body bars with upper and lower wick, generally that tells you that the upward momentum is losing strength. So it could be almost like the uptrend is almost reaching its peak. Vice versa, if you see a red candle with upper and lower wick, it's also telling you that downtrend is almost the strength starts to diminish. So you have to be careful. Now, the second and the one that is most important is that if you start to see white body candles, white body green candles with only upper wick, is telling you that this bullish momentum is strong. And again, if you start to see white body bars and with lower wick, it generally tells you that this downtrend is actually quite strong. So importantly is that you need to have a candle which is very white in terms of their body, and if it's a green body bar, candle bar, you need to have upper wick. The best is that sometimes you don't even see a wick. That usually means that the market is actually very bullish. Vice versa, if you start to see red body candles, it needs to be a lower wick. If you see upper and lower wick, that generally tells you the market is going to be a neutral phase. That means the momentum, the strength of the particular trend is losing its momentum. So you have to be careful. Now, the third distinct pattern is that if you start to see a small body candle with very long wicks, almost like a doji style or almost like a cross, that usually tells you that the market is indecisive. So the market could be transitioning from a trend phase moving into a consolidation phase with the appearance of this type of candles. So when if you are still holding on to a position and start to see candles like this with a cross or almost like a dodgy style of candles, you got to be careful. That usually tells you that the trend is almost exhausted and it's moving into a consolidation phase whereby it's going to be a range. And in a range market, if you try to apply trend trading strategy, it usually doesn't work. So that usually be a time in point where these are the point where, or these are the period where I should be getting out if I'm still holding on to a position, because the market is transitioning towards a sideways market. So let's put into the dynamics of it. So these are what we call samples of red body bars. So if you start to see white body candles, white red body candles with lower wick, generally tells you the market is on a downtrend. So be careful when the body of the candle starts to get smaller and you start to see almost like a dodgy style candles, is telling you that this downtrend is almost losing its strength. So it's time for the market to consolidate and wait for the next trend to be in place. So now this is the dynamics of it. You can see appearance of strong green candle bars. So it's telling you that this is a short-term uptrend. So be careful when you start to see red body bars appearing and almost dodgy style. So that's telling you that the market is moving to a consolidation phase after this short-term uptrend in price. So now this is sitting very well, like I highlighted earlier in last couple of slides, where the candles are holding well above the EMA 50 period EMA. So again, it's telling you that despite we see a bit of retracement in a short-term basis, or the market looks like it's ranging, but overall it's still supported well by the EMA and it's still showing you an uptrend basis. So be careful with small body candles or dodgy or almost like a cross type of candles. That tells you the market is actually consolidating. So during this time, if you try to apply trend trading strategy, it's going to be very difficult. Now, next bit, if you just use Heiken Ashi, is not sufficient enough to give you a proper entry strategy. I think you need to accompany that with also with moving average as one bit to probably help you identify better when the moving average or when the candle starts to cross, or when the moving average starts to cross. Usually that be a better signal to accompany. Just if you just use purely Heiken Ashi, it will not suffice, because candles sometimes may give you misleading signals as well. So there's many types of moving averages. I think I just want to focus on EMA because keep in mind, moving average is still a lagging indicator. It lags against because it uses historical prices, but exponential, because it gives more weight for the current price, it tends to move or tends to envelope price action quite closely as compared to other type of moving averages. Now, way to use moving averages, I mentioned one earlier, which is if the price is above the moving average, generally that tells you it's an uptrend market. If the price is below the moving average, that generally tells you it's a downtrend market. Now, the second main function for moving average is to act as a dynamic support and resistance. So I showed you earlier where the candles are still sitting very well above the 50 period EMA, especially for the daily gold prices. It still generally tells you that as long as it doesn't break below the 50 period EMA, this uptrend is still quite intact. So in a sense that the moving averages is also acting as a support and resistance. It's treated as a more dynamic support and resistance for your candles. And the third one, normally this is what we commonly use, is to look at crossover signals. So if you pair a shorter term and a longer term moving average together with your Heiken Ashi candles, so bullish crossover signals is when the shorter term crosses above, and bearish signals are when the shorter term crosses below. So that's also another signal they can take. So what we have here is a bearish crossover example, whereby you can see the shorter term crosses below, and the appearance of red Heiken Ashi bars, and the candles are starting to go below both the moving averages. So in a sense that this is a good setup to take a short position. And be careful when the moment it starts to break above the moving averages. It's just telling you that this downtrend is almost exhausted. It could be a consolidation, or it's going to be it could be a next phase of trend in the market. So it's always good to use crossovers together with your Heiken Ashi to give you better insights on where the market is actually trending to a certain direction. Okay, and keep in mind, like I mentioned, highlighted earlier also, the moving averages can also act like a support, dynamic support for your candles eventually. So you can see some couple examples here. The green candles are still appearing and sitting well above. This is basically a 9-period EMA line, which is the red one, the shorter period. So that, in a sense, is acting like a dynamic support for your candles as well. So Here is a classic example. The candles are sitting well above the red line, which is the 9 period EMA, and in a way, it's acting as dynamic support. And here is also acting like a dynamic resistance for your particular for your particular candle. So as long as it doesn't break or penetrate, the red line is telling you that this downtrend is still quite intact at this point in time. Okay. Now, as I highlighted earlier, I'll talk about DMI. Although it is a trend indicator, but DMI, is the main function is to look at the ADX value. Now, in this indicator, there's actually three different lines that it measures. The first one is what we call positive DI, which usually measures upward momentum, and the second one, negative DI, usually measures negative momentum, and the third one, ADX, which is the crucial one, is to measure strength of the particular trend. Now, the positive DI and minus DI pretty much act like your moving average crossover. So when the positive DI crosses above the negative DI, which means positive momentum is stronger, normally it means that it's going to be upward momentum in the market. Now, vice versa, if minus DI crosses above the positive DI, generally that means the negative momentum is going to be strong. So that usually happens when the downward market. Now, ADX is the one that's crucial. It measures strength. So there's no point to enter a trend when the ADX is coming down, which tells you that you're pretty much the uptrends or downtrends almost peak, and it's time for the market to go into consolidation. So just an example of how the strategy works. So you can see here there's a couple of crossovers here. So the rate minus DI crosses above usually tells you that generally the market is coming down, and if positive DI crosses above or above the rate minus DI, it's generally tell you the market is going up. So if you just look at if you compare that your moving average crossover signals, that actually they are quite overlapping in terms of their decision. So it's either you can use moving average crossover or you can use DMI crossover strategy, because both these signals are actually overlapping in a sense. So because they are giving or generating the same signals. So here's another couple of examples where whenever there's a DMI crossovers, it's actually quite overlapping your moving average crossovers as well. So in a sense that both these signals are in a way quite redundant. So you can either choose a moving average crossover, or you can use a DMI crossover. Now what's important is that this DMI is actually this black line here, which is your ADX. So a couple of examples here. I draw a blue line, which is indicate a value of 25. So ADX runs on a value from 0 to 100. So anything that's above 25 in terms of ADX value is telling you that there is appearance of a trend and the trend is getting stronger. Now, anything that's below 25 or even below 20, generally that means the market is flat. It means there's no trend in place. The market is consolidating. So just a couple of examples here. ADX, this black line crosses above 25. You can see that this upward momentum is actually getting stronger. Now, be careful when ADX starts to peak or starts to come down. It's just telling you that this uptrend is almost reaching its peak. In fact, market could be consolidating. And keep in mind, if you just look at any value of ADX below 25, generally that tells you market is actually quite sideways market. So if you try to trade when ADX value is below 25, it just generally tell you that the market is in a sideways market. So you can't really get good signals out of it. Now, last bit when it comes to trade management is always you must have a way to manage risk, and this is the most important aspect of trading. So one of the ways is to look at the average true range of the particular period. So true range measures the high and low for that particular period in measured. So high ATR in terms of value usually tells you market is very volatile, and low ATR usually means that the market is less volatile. Now, when the market trends, like now what we're seeing in the gold market, which is the uptrend market, the ATR value increases. So that tells you generally when the market trends, you should expect the ATR value should increase as well. Now, if gold market is sideways or it's not moving anywhere, it's not going up or neither is going down, usually the ATR is going to be very low. So that also ATR can be a good indication to tell you whether the market is trending or not. So like I highlighted earlier, the gold market has experienced high volatility in this couple of months, whereby the daily range has actually increases to 100 US dollars. So that also tells you that generally the market has actually been trending for a period of time. So how do we use ATR to set up your risk management? Is basically once you identify entry setup or entry mode, here is a very good example where you can start to see green Heiken Ashi bars, which is both the moving average. and generally you get a bullish crossover on moving average. Your ADX, the key one is rising above 25. So the key thing is rising and it's above 25. So it's telling you that possibly that this could be a momentum on upstrength, on an upward momentum. So ATR is about 10 cents. So basically, you can long entry at 51.29, which is a silver market. Your ATR value is at 10 cents. So your risk to reward ratio, if you use 1 to 2, you're looking at 20 cents as your target profit, 10 cents as your stop loss. So that's how you use ATR to measure your risk going forward. Now, risk to reward ratio 1 to 2 is ideal situation, and it's very individual. Some will prefer a higher risk to reward ratio, some will prefer a lower risk to reward ratio. Now, as long as you have positive as expectancy of the trade, which is a profitable trade, as long as you have high reward compared to risk, you are fair enough. So keep in mind, risk to reward ratio is highly individual, depending on individual. So it really depends. But using ATR as a factor to measure your risk, in a sense that if the markets is volatile, you put too tight of a stop loss, you tend to get stopped out quite easily. So ATR helps to measure that. As the markets gets more volatile, you should be adjusting your stop loss position as well. But keep in mind, high ATR value, that means you must be prepared to put a high stop loss value because markets are more volatile. Now, this is another example. This is on gold. You can see that the green Heiken Ashi bars are the bodies are getting wider. It's above the moving averages, and ADX is above 25 and is rising. ATR is 60. This is basically a daily chart. So when ATR is 60, so you got to be prepared. So if you work on 1 to 2 risk to reward ratio, that means you're risking 60 points for 120 US dollar as your reward. Okay. Now, in terms of where we are right now in terms of gold prices, you can see that ADX has actually come back to 25 and actually slightly below 25. So it's telling you that market generally, in terms of a daily perspective, gold prices is pretty much consolidating at this point in time. So, the moment it starts to go above 25, then market is showing you trend again. Now, ATR is also starting to come down. It's doing about 110 to 100, high and low range. So it's also telling you that slowly the market momentum is moving to a consolidation phase rather than a trend phase. Now, silver on the other hand looks slightly interesting because ADX is still hovering above 25, but last couple of days showing you sign that it might go above 25. So once that happens, that usually means that there's potential trend in place. And if you just look at where the candles are, I think silver is this shortfall of hitting an all-time high again. So breaking above the recent high. So really, I think silver has more potential in terms of more potential than gold in terms of technical perspective. But be on the lookout. I think silver might have a trend in place in the coming days. So how do we participate? Now, gold and silver market has experienced a lot of volatility in recent times. So therefore, I think for you to participate in the gold and silver market, those days is actually quite difficult because the margin required is actually quite extensive because the contracts are large. Nowadays, I think with CME introducing small contracts, it gives a lot of big opportunities. So now with micro gold, the margin is about 2,000 US dollars. Margins does change quite frequently, so make sure you have the latest margin. You can always consult Phillip Nova on that. They're more than happy to share you the latest margin. So with 2,000 US dollars, you can participate in the gold market and gain an exposure. Now, a lot of people say micro contracts are small. Do we have volume? Now, the daily volume, you look at it, it's actually been rising, but in exchange, I think daily you're looking at 60 to 80,000 contracts traded on the micro itself. So it shows you there's actually a lot of interest and volume that's actually competing in the market. So there will not be an issue where the bid and ask will get wide, or will there be a position, or will you be encountering position where you cannot come out of the market? I think those scenarios are unlikely to happen, given that daily volumes are actually in excess of 60,000 and above. So I'm just gonna end here with a quote. So a lot of traders are always too accustomed on, when do I make the big buck, or when do I make the big break? Always focusing on profit rather than the loss potential. So I'm just going to quote a few quotes from this book called Best Loser Wins by Tom Hogarth. So if you have not read his books, I highly recommend, because I think the way he expressed trading psychology by emphasizing that it's important for us to emphasize our loss as well, because I think what makes make or break a trader is about the he about how he or she actually comes out from losing positions. Because if a trader comes out from losing positions, if it's he or she mentally break down during a losing streak, that usually spell the end of a trader. So I think it's important to always define our risk, especially when we're encountering consecutive losses or large losses in our trading journey. So he mentioned this belief in defining his risk, and he always don't believe in defining the reward. Reward is always secondary. The risk is always the first one. And people always say, what is the mark of a good trader? I think he put it very well. I think the mark of a good trader is that he or she is good at losing. There's no point of emphasizing your wins, but it's very important to emphasize how do you come out from a losing position. Okay, so I think with that, I'm just going to end here. I'm just going to hand it over to Sri for any questions from the audience that I can happily address.
Great, great. Okay, we have three questions right now, members of the audience. If you have more, you can send them through, and then we'll try and pick them up as quickly as we can. First question is from one is asking, please share your thoughts, your technical analysis of gold trend right now. Do you have a slide on that on hand, David?
Yeah. So I think for trend right now, you can for gold in particular, you can see that in at the current moment, the ADX is probably still at 25 or slightly below 25. It's just telling you that the short-term uptrend maybe is exhausted. So I will wait patiently. If ADX starts to go above 25, then I'll establish a position. As of now, I'm still waiting as to where the next move is in terms of gold, in terms of technical perspective, because is still pretty much like a consolidation phase at this point in time.
Okay, so the next question is okay, this is from Molly. Molly is asking ADX indicator and Heiken candles, are they suitable for SG stocks or better for use with gold trading?
Okay. I can't comment about SG stocks or stocks in particular because my nature of trading, my focus is always in the commodity and futures market. So in this regard, in the gold market, I mean, this strategy usually works when the market trends. Now, if the market is not trending and is moving sideways or consolidation phase, usually identified by ADX below 25, it's very difficult to use Heiken Ashi or in fact try to use DMI indicators. So I would say, in general, when gold prices tends to move to a certain direction in a trendy fashion, given the ADX is rising and Heiken Ashi candles are moving in certain direction, then I would say this strategy tend to be helpful in terms of navigating entry and also exit strategy.
Okay, David. Okay, so this is the last one that we have right now. Members of our audience, if you have any other questions, please send them our way. Okay, some sources say the central bank gold reserves increased by only 5% and gold prices rose mostly because of news that central banks are buying and because our Donald Trump decided to depreciate US dollar to compensate the trade imbalance. Do you expect the dollar to continue depreciating in 2026? Like I mean, bearing in mind that we are in a interest rate lowering cycle for interest rates. And the follow-up question is, do you think gold price has already priced in the Fed rate cuts?
Okay, yeah. I mean, this is my opinion. So I mean, generally, if you look at
Mm.
where U.S. Dollar strength is, I personally believe that if dollar continues to weaken, inflation is going to be a major concern. Now, with Trump tariff is pushing general price increases across all U.S. Markets. So Federal Reserve is also very concerned about interest rate. It's not only concerned about weak economy, unemployment, but inflation rate is part of the equation as well. So I would say my personal opinion is that you can't depreciate the US dollar too much to extent where inflation is going to be a concern. And I mean generally, if interest rate will start to come down, it's going to be beneficial for gold. But I mean, as to how low interest rate is going to go, is still I mean to me is a big question mark. But I mean, to a certain way, I will, in a sense, put it as, interest rate in US can't go too low as to during the pre-COVID levels, but it will remain much lower as to compare where it was 2 or 3 years back, and I think that will be a temporary support for the gold market. Now, whether as to gold prices as of now price in the potential, decrease in interest rate, personally, I think it could be, because the price increase in gold market is actually very steep in the past couple of months. So whenever you start to see, like I said, when prices are increases such a steep pace in such a short span of time, it usually generate a lot of interest, public interest to really go into the market and liquidate their positions, or get their profit in hand, and that will put pressure. So I would say this. I mean, if you ask me, my personal opinion, whether the price is actually priced in, the decrease in interest rate, especially coming from the U.S. Federal Reserve, I think is slightly. But I would say there's obviously other factors that can really support the gold market as well. Now, as to reports where central banks are, some are claiming that it's not as much reported. Now that remains a mystery. China's central bank is, I'm not sure whether there's a report that came out a couple of days back. They state that China is in fact very discreet in terms of displaying their interest. So whether what they announce is real or not is still a mystery. But based on what we gather, or based on the data that is shown, it looks like there is actually genuine buying interest. But whether that is translated into to actual buying or not, is still a mystery. But if just work on the data itself, yeah, is you can see that there's interest from central bank, be it from China or across the world, when it comes to shoring up their reserve with gold.
Next, we have okay, our last question for today is quite interesting. All right,
Sure.
so David, what's your thought on what's the impact on gold? Should Russia and Ukraine manage to strike a peace deal?
Okay, I would say the immediate impact will be definitely be uh, I wouldn't say a sell down in gold, but it's an ease of interest to need safe haven asset, which gold in this particular case. So you're definitely going to see there's a there's a retracement in gold prices. Because keep in mind, gold is always used as a safe haven, and geopolitical risk is usually what prompt people to move to safe haven asset. But gold is not the only one. There's also other asset classes that can act as a safe haven asset. So I would say this: if there's less tension in terms of geopolitics, of there's easing of tension, that usually spells there's less interest in the gold market. So if Ukraine and Russia tension starts to ease, I would say there's probably going to be a bit of retracement in the gold market.
All right, thank you so much, David, for your time,
Sure, thank you.
and thank you, members of the audience, for joining us today. Until our next webinar, have a great trading week ahead. Bye bye.
Thank you. Bye.